A really difficult thing to understand when learning about GST is why is there no GST on sales? Well, let's recap. Here's what we know about GST. We call it GST clearing, and we assume the GST clearing account is a liability. It may be, it may not be, but we assume it is because now it has the rules of a liability in terms of debits and credits. And the metaphor we're using is it's a big tub of obligations or debt to the government. So when we make sales and charge GST, like in this case, there's $10,000. So when we receive GST or charge GST from customers, it goes into the tank and it increases our liability. So the GST account would go up on the credit side. However, the government designed the system to recognize that a business also pays and gets charged GST by its suppliers. So if we had these things here for rent, insurance and inventory, and we had GST amounts, and that came to 8,000, our liability here would go from 10,000. It's going to go down to 2,000. And when a liability goes down, that's a debit. So that's what we know. And then we looked at an example where there's a cash sale of $1,000 on the 1st of March for plus $100 GST. And the cost of sale was $400, and we've learned our debits and credits on that. So the first thing is we'd have more cash, which is an asset, going up, so that'd be a debit. We've also got a sales account, which is a revenue. Revenues are going up, and the rules say that's a credit. GST clearing, we're charging $100 GST on this sale. GST clearing is a liability. It's going up, and when a liability goes up, that's a credit. We've got our debits of 1,100 equal our credits of 1,100. Beautiful. And then we've got cost of sales. Cost of sales is an expense. It's going up, and the cost of this sale was $400. So when an expense goes up, that's a debit. We have to give up some inventory to make this sale. Inventory is an asset. It's going down, and when an asset goes down, it's a credit, and our debits equal our credits. And the main thing here is our accounting equation balances. So we always want to check this after every transaction. So in this case, we've got an asset increasing called cash, 1,100. We've got a revenue increasing 1,000. What that will do is revenues increase owner's equity here, so that will make owner's equity go up. We've got the GST clearing liability going up 100, so liabilities go up, and that balances. We've got $1,100 of assets equals $100 of liabilities plus $1,000 of owner's equity, so together these equal 1,100. And then it's this bit. We've got cost of sales, which are an expense. Now it's an expense going up, but in terms of the accounting equation, expenses decrease owner's equity, so this would actually make owner's equity go down. And lastly, we've got this inventory asset going down 400. And this little part balances too. We've got negative 400 equals 0 plus negative 400. Beautiful. And if we balance all that out, we'll get assets going up 1,100 but down 400. So that's a total of up 700. Liabilities went up 100. And owner's equity went up 1,000 but down 400. So that's an increase of 600. So that's how we would process a cash sale with the GST. And I guess the question is, why was there only GST on the sale amount of 1,000? There was no GST on the cost of sales. Well, let's look at why. Let's just go back a step. Let's just deal with this transaction, 1st of March. Let's deal with this bit. Cost of sale was 400. That must mean we had some inventory in stock and we sold it. So why don't we go back a step and say, we bought this inventory. Here's our business here. We bought it from a supplier. Let's say we pay cash. It doesn't matter whether it's cash or credit. But let's say we did. From this supplier, we bought inventory of $400 plus $40 GST. Okay. What would happen there? Well, a few things. So the first thing is we've got more inventory. Inventory is an asset, and it's going up. When an asset goes up, that's a debit. So we've got $400 of inventory. Now, we also have this GST. It's called GST clearing. It's a liability, and we've learned that when we pay or get charged GST by a supplier, that makes the liability go down. So when a liability goes down, that's a debit. And lastly, we'll just say we pay cash. If we had credit, it wouldn't change things too much. We'll deal with that in a later video, but we'll say cash is an asset. We're paying cash, so it's going down. So that would be a credit, and we're paying $400 plus $40. That's a total of $440. Our debits equal our credits. Beautiful. Let's just look at the accounting equation first. Let's have a look, just make sure this all balances. We've got an asset going up 400 called inventory. We've got a liability called GST clearing going down 40, so that goes there. And then we've got another asset called cash going down 440 there. If we were to balance all this, assets have gone up 400 but down 440, so that's a total of down $40. Liabilities have gone down $40 and owner's equity is 0. So we can see here negative 40 equals negative 40 plus 0. Beautiful. That all balances. But what we want to look at is what would happen here when we post. We won't worry about inventory or cash. Let's just go and post this. It's called GST clearing. It says do a debit on the 40th there. I'm just going to make up a date and say we bought this on the 21st of February. No particular reason. It just, I don't know when we bought it. I know we sold it on the 1st of March up here. But when we bought it, we're just going to make up this date just because I'm going to reference it in a second. So that's what would have happened to GST clearing. All right, so let's figure out now, why aren't we going to charge GST on the cost of sales when we actually sell this inventory? So let's go back to the 1st of March. Cash sale of $1,000 plus GST, exact same as we had before. Cost of sale is $400. Let's deal with the sale amount. We had cash went up $1,100. We had the sale and the GST. That's the same. So let's keep that exactly the same as it was before. Let's look at the next bit. So why is there no GST on the cost of sales? So cost of sales was an expense. It went up. That was a debit. So that's $400. Then we had to give up inventory. Inventory is an asset. It's going down. So that's a credit. And then we're done. What we're saying here is, well, why don't we do this then? Why don't I go to GST clearing and say it's a liability. It's going down because I kind of gave up inventory. That would be a debit here. Couple of problems there. First of all, let's look. Our debits don't equal our credits. I've got $440 of debits, but only $40 of credits. So that doesn't work. That doesn't make sense. So that's one reason why we don't charge GST on the cost of sales. But let's look at the other reason. In this GST clearing ledger from earlier, so back in February, we said 21st of February, there was a debit for 40. All right. Now remember, this is a decrease to a liability. We're going to get this money back from the government. Okay, that's the way the system works. Now, if we were to do this again on the 1st of March and go to GST clearing here and do another debit, I've double counted. First of all, I don't have a cross-reference because there is no credit for it, so that doesn't work. But I'm now going back to the government saying, can you give me $80 of GST back, please? When really, I should have only asked for 40. So it's double counting. So if we could just summarize this and go, all right, why is there no GST on the cost of sales? We could say, because the GST was recorded when the inventory was purchased in the past, which in this case was the 21st of February. GST does not need to be recorded again when the inventory is sold today. Okay, we've already recorded it. And if we did do that, if we did record it again, this would result in double counting the GST paid by the business. First of all, that's wrong. You can see it's 2 debits here when we should only have 1. It's also illegal because we're telling the government to give us $80 back when really we should be only getting $40 back. So that is why we don't record GST on cost of sales.